Taxes. They suck, right? Worse than rain in paradise. Seriously. That's why today we're talking about a tax deferment strategy called a 1031 exchange. So stay tuned. Welcome one and all to another episode of St. Pete Beach, Florida Living. I'm your host, Tracy Forth, Fancy Lady of Real Estate with Dalton Wade here in beautiful, world-renowned St. Pete Beach, Florida. Today we're talking about 1031 exchanges, which is a tax deferment strategy. But before we jump into that, if you like hearing about St. Pete Beach, St. Petersburg, Tampa, our beautiful beaches, investment opportunities here in the Sunshine State, go ahead and like and subscribe to my channel and you'll hear more about those things.
A 1031 exchange can be complex. Many think that this is a tax loophole. It is not. It is a powerful tax deferment strategy that involves exchanging one investment property for one of equal or higher cost. So the funds are basically rolled over into the second or newer property. The key benefit of the 1031 exchange is found in the fact that the transaction is an exchange, not a sale. This is ideal for investors wanting to maximize their return on investment. It can be used for land, single-family homes, multifamily homes, commercial. You can even sell a property in one state and use the funds to buy in another.
I work with investors all over St. Pete Beach, Clearwater, Tampa Bay, and a lot of these folks are newer investors and they haven't heard of 1031 exchanges. So it's very exciting when I can impart knowledge that actually helps them keep money in their pocket. Okay, so step number one isn't rocket science. You need to identify the investment property you'd like to sell. Now, this cannot be your primary residence. The property actually has to be either an investment property or a business property. Could be a single family, a multifamily, an apartment complex, a piece of land, a commercial property, any and all of the above. Okay, who doesn't like a little storytelling? So we're gonna tell a story to give you an example of how an exchange works. And for this example, we're going to use Susie. Susie, I love Susie. Susie bought a duplex a couple of years ago from me, and she's been earning some nice funds from the duplex. But gosh, Tracy, the market is so hot right now, I think I want to sell. And I tell Susie some great news. I tell her, Susie, your duplex is now worth about $1.5 million. Cute little duplex close to the beach. Are you sure you want to sell, Susie? Uncle Sam is going to want his cut. And she's like, I want to sell, Tracy. But what are you going to do with those funds, Susie? Do you need them right away? Well, no. You really want to pay Uncle Sam 20-30% from your proceeds when you sell that property? Tracy, what do I do? Susie asks. So I tell Susie about a 1031 exchange. Susie, you sell your duplex, but then, well, that's step two. Step number two, you have 45 days from the date the other property sells, your current property, to identify the property you want to purchase. And you can pick a few, but you've got only 45 days to identify those and get those identified properties in writing. And then from that point, you have to close on that next property within 180 days. Step number three, choose a qualified intermediary or exchange facilitator. This is a professional that will hold the money in between the sale of your current property and the purchase of the next one. You do not want to touch $1 of that money unless you want Uncle Sam to touch it too. The intermediary comes into play in basically handling those funds, so you're not touching them. Now, this person is a qualified expert, that is their title, and there are organizations, this is what they do, this is all they do. And it can't be a relative, this is not your accountant, This is not your attorney. This is an intermediary. And another quick note, you cannot be your own intermediary. No, no. The cash needs to be held by a professional intermediary, and they'll hold those funds until the exchange is complete. Now, step number 4 is decide how much of the sales proceeds you want to roll in or take. A lot of my investors are very excited to hear that they can actually keep a portion of the funds. They don't have to roll every cent in, but just keep in mind, any money that you do keep will be taxed. Now, at the beginning of the video, I told you I would impart you with some really cool knowledge that would allow you to basically defer taxes indefinitely. If you don't sell, like ever, that's how you avoid paying taxes. So if I was to purchase an apartment complex and I just never sold it, I just hung on to it, and then I pass away and I leave that apartment complex to my children, they can't be taxed on that property. Nope, death benefit. Not that I want to die, but. Number 5, step 5, easy peasy. There is an IRS form called Form 8824, very creatively named, I know. And what this does is it identifies the properties that were involved, the timeline, who was involved, how much money was involved, all that good stuff, because IRS needs to track all this, make sure everything's on the up and up. Easy peasy, you can even hand that buck to your accountant. Just make sure you have the details to share with them. And enough said. Now I think it's time to hit the pool. So y'all take care. Let me know if you have any questions. If you have a 1031 exchange, you want to invest in Florida, you know who to call.